Okay, away we go. Thanks everyone for joining me. Again, Sean Ruggiero, Family First Life Annuity. We're going to talk today about understanding fees in mutual funds. All right, why mutual funds? Well, the vast majority of retirees' money is in mutual funds. One form or another, they're in mutual funds. Why is that? Well, there's a reason. If you look at until recent years, okay, when I say recent years, there are a few more emerging options for insurance companies to manage money inside of qualified accounts. Qualified meaning by the Internal Revenue Code, like a 401k, a 403b, a 457, right? All these pre-tax accounts, all these retirement vehicles, insurance companies have gained a small foothold, but the vast majority of retirement funds are managed by money management companies. Okay, Janus, Fidelity, right? Voya Financial. These are companies that manage your retirement funds. Okay, they put them in different stocks and different mutual funds, different sectors. Large cap, small cap, international growth fund. So if I'm working at Boeing, if I'm working at ABC Grocers, if I'm working at XYZ company, I'm investing in a qualified account. I'm investing in my, let's just call it the 401k, universally speaking. That 401k is being managed by Fidelity, Fidelity, the investment company. And they're putting it in different sorts of mutual funds based on the parameters and the package that they pitched ABC company on. And I get to choose those different investments, and I can choose if I want to be less aggressive or more aggressive. And every month I put in money, and let's say the company matches it, and my accumulation, my retirement grows. Let's say I'm 30 years old, 40 years old, 50 years old. At no point have you ever heard me, nor will you ever hear me, say that that's not a good idea. See, the market's a great place to put money for long-term growth, especially when, and in some cases only when, you're contributing on a monthly basis, on a regular monthly basis. See, if I'm putting money in every month into a stock account, into a mutual fund account, and let's say it's $500, and that buys me 50 shares, okay, at $10 a piece. And then the next month the stock market goes down, and the shares are now $5 a piece, but I'm still putting in that same $500, how many shares do I get? Well, I don't get 50. I get 100 shares. See, if you understand something called dollar cost averaging, putting in money every month over time, you'll accumulate more wealth than if you just stuck money into an annuity every month. It's not what annuities are designed for. We don't go out there with series licenses, and we don't go out there and say, I want to start handling your investments. One, it's a headache, okay? You're not going to get too much of commission off a $500 deposit or a $100 deposit. Yet people will have questions, okay? It's one of the reasons why Matt and I don't do that business anymore. But when they're investing the right way in these mutual funds, over time, they're going to accumulate a lot of money. What your job is to understand how those mutual funds, when you transition from the accumulation phase, right, the rise to the decumulation phase, how those mutual funds now are not necessarily the best option. See, when you go from putting money in to not putting money in, mutual funds are not necessarily the best option. The stock market, the securities market, the equities market, these are just different terms for the same thing, is not necessarily the best option. So you, as a retirement income specialist, need to be able to explain that to your clients and show them why. Because here's what's going to happen, leading back to my first point, is that if the vast majority of people that we work with who have accumulated any sort of lump sum savings, retirement, whether it's 80K, 180K, or 580K, we tend to work with the underserved. We tend to work with people that maybe have $300,000 of total retirement assets. That is not a very wealthy retirement. They're relying heavily on Social Security. They're relying heavily on pensions if they're lucky enough to have one. We're helping those people, the people that really can't tolerate much loss because they need every dime of that money to live off of in retirement, to fight inflation, to fight longevity, all these different sorts of things. And so if those people had been investing in their 401k, most people that we run into that are in that situation, most of them have qualified money. And that qualified money was managed by, to use my previous example, Fidelity. So if I've used Fidelity my whole life, I don't even know anything differently, and I quit, I retire, I'm no longer working at ABC Company, then who am I most likely to have my money with in retirement? Fidelity, right? So they say, okay, you have 30 days to move your money. Thank you, Sean, for your 28 years of service with ABC Company. In fact, a Fidelity representative will contact you about the option to move it to an IRA. Now, I can move it anywhere I want. I can choose an IRA with Vanguard. I can choose an IRA with Athene. The list goes on and on and on and on. But I don't really know that. Fidelity has managed my money for the last 17 years through the company. It's a natural fit. So most people, because of how they grew the money, will have their money in retirement with the same sort of vehicle, which is mutual funds. Okay, so let's take a look at this now and dive into it. Let's do a quick review. What are the retirees' options? See, when I've hit my accumulation, and I've told you that the securities markets, the equities markets, the stock market, the green box to my left, that's the best option. It's proven to be the best option to accumulate money. But when I retire, when I stop putting money in every month, when I stop taking advantage of that dollar cost averaging, what are my options? Well, you can leave it in the securities market, which most people do. You want to be real safe, okay? You want to have it guaranteed by the FDIC, you can put it with the banks. Put it in a CD or a money market account. You're not going to outpace inflation. Heck, you're barely going to make any money at all, but it will be safe. And lastly, you can choose to put it in annuities. And so if we can choose between these three, now, and I know some of you on this call, we got quite a few people, almost at 100 on the actual webinar, probably more listening. I know some of you are raising your hand and say, wait a minute, you could do a self-directed IRA. You could do real estate. I get that. I'm talking about the vast majority. I'm talking about your average wheelhouse client, the underserved. They usually don't have the faculties to go out and create some sort of real estate trust with their retirement, right? So the vast majority of people you run into, and if once out of every 6 years you run into someone that knows more than you, then you're not selling them an annuity, right? They don't need your help. Move on. Okay? And the chances are of them filling out a form or even being interested are probably slim to none. So for the most part, the vast majority of people have three options. Put it in the stock market, leave it with the banks, or take out an annuity. So now we need to understand why the stock market dominates that retirement. And I said most of the time it's because they had the money with the stock company, with the financial advisor. So they kept the money with the financial advisor. But we need to understand what that means and why that is not necessarily the most advantageous decision for the client. And in fact, it can be a detrimental, even catastrophic decision to leave your money in the stock market in retirement. So first, we need to understand what that means. So if you are going to invest in the markets, if you're going to have a Securities and Exchange Commission a registered investment, what does that entail? Well, we're talking about mutual funds. We're talking about index funds. We're talking about stocks, individual bonds, and then something called ETFs, or exchange-traded funds. Exchange-traded funds are just pieces of a mutual fund. It's like a casino chip that represents some money. Think of it as a stock chip, so it's traded like a stock, but it represents a mutual fund. All right, when it comes to qualified funds, the tax implications really are no different than a mutual fund. When it comes to non-qualified funds, there are some differences, okay? But performance is going to perform just like mutual funds do. An ETF, let's say it's a technology sector ETF. It is an exchange-traded fund that represents a bunch of little pieces of different technology stocks. It functions just like a mutual fund. So really, taxation is slightly different, but that's it. You'll never need to know that. You never need to worry about it. But if you ever hear someone say, well, I have some ETFs, great. They have little pieces of mutual funds. Think of it the same way. Okay? Now, we only have to concern ourselves really with two of these, mutual funds and index funds. What's the difference? A mutual fund, we're usually referring to something that's a managed fund. Okay? Someone who's paid a lot of money, or a group of people who are paid a lot of money, sit there and decide what to do with the stocks. There's lots of subjectivity to it. If it's an index fund, it's what's called a passive fund. So the expense ratios, the fees, they're way, 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 way lower, and no one tells it to do anything. They either pick the stocks or they track a certain index and let it go. What's funny is that over the last 10 years, index funds have outperformed mutual funds. The problem is this: index funds don't pay very well. So guess which ones people are mostly in? The mutual funds, the managed funds. Okay, we're going to dissect that in a little bit. We're not going to worry too much about individual stocks and individual bonds. If you're managing a 401k for a company, let's say I manage the Voya account, or I'm with Voya and I manage the 401k, what they call the VIP plan for Boeing. I'm not even allowed to purchase individual stocks inside that plan. It's too risky. Something called single stock risk, right? I remember Mark once had a client, and she had $40,000 in Ford Motor Company, and she was like 83 years old. I said, why? $40,000. What's that worth today? Well, it depends what Ford Motor Company is. Look it up. I think the ticker symbol is F, right? And so if F is up to $8, she's okay. If it goes to $10, she just gained a bunch of money. The next day it went down to $6, right? And I'm being a little hypothetical. It's not like it was moving up that much volatility, but it can. From one day to another, an individual stock can change immensely. So most retirement accounts, they're not even allowed to put your money in individual stocks. So you're not going to see that. So don't even worry about individual stocks. It's not day traders. This is not E-Trade, Scott Trade. You won't find those. If someone's doing that in their own volition, that's their decision. You're just not going to find a money manager. You're not going to find a financial advisor picking a bunch of single stocks. There's way too much risk and exposure for that person. They're going to be putting them in mutual funds. And same thing with bonds. Even though you will find a lot of bonds in retirement accounts, you won't find individual bonds. It's usually bond funds, okay? And then, like I said before, exchange-traded funds, you will find those, and they're more and more prevalent, but they're kind of a moot point. They're going to perform just like mutual funds. So let's understand mutual funds. Here's an important thing about mutual funds. They have a ticker symbol. Why is that important? The ticker symbol is there to identify it and allow you to do research on it. I already explained there's two types: the passive management, the index fund, and then the managed fund. Okay? The passive fund is a superior tool. And that's not subjective. That is actually objective. There's numbers that can support that a passive fund, an index fund, such as Vanguard. Vanguard just pumps out index funds. My wife's retirement, her IRA is in Vanguard. Okay? Because I believe in it. I think it's a great tool for retirees. I think some of your money should be exposed to the markets, okay? The problem is we run into people that have $160,000 period. They can't lose a dime. And that's where fixed index annuities really shine. Because even though it's an index fund and the expense ratios are much lower and there's no load fee, it still could go down. Because if the market goes down, it will go down. So understand, as much as I promote Vanguard as being a great option, personally speaking, I think that. I don't sell it. I'm telling you, I think that as an individual. It doesn't mean it'll insulate you from risk, okay? So just keep that in mind. When you talk about load fees, managed funds, I think it's a terrible idea. It's a crapshoot. You might find 1 out of 10 that outperforms the market, but for the most part, you are spending a lot of money up front for no guarantee. And in fact, the only statistic you can point to is that it is underperformed index funds, okay? And that's what you're going to find because that's where the big commissions are. So two types of funds, passive or index, and managed funds. So dissecting managed funds, because that's the ones you're going to see, there's 3 classes of shares. So I can buy a certain fund, like, I just pulled one out, a J.P. Morgan Chase fund. It's an equity income fund, very common fund, has something like $6 billion in investments in it. Its ticker symbol is OIEIX. There are 3 versions of that stock, or that mutual fund. There's an A, B, and C. Now, what's funny is you look at people's statements, they don't come right out and say you're getting charged 5.25%. These statements are tricky. You think an annuity contract's hard to read? Take a look at some of these people's statements. An A share of OIEIX is going to charge you 5.25% up front. So if you invest $100,000 with JP Morgan Chase, and they say this is a very strong and highly recommended mutual fund, we're going to put $100,000 into this mutual fund. You immediately are losing $5,250 to them. So you're 5.25% in the hole. Your account's already down to $94,750 day one, with no guarantees it'll go up. Now, you have other options. You won't see them as common or as often, but you have a B share option. It's a deferred sales charge. Okay, so it's going to have a slightly lower charge, 3% to 5% over the next 5 years. For example, this same JP Morgan Chase Equity Income Fund, the OIEIX, the B share equivalent, has a deferred sales charge of 5%. Okay, so they'll charge you a little less, but they're going to charge you when you sell it. And then C-Shares has a long-term deferred sales charge. So it's much, 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 much smaller, 1% or 2%, but it could last for 10 years, okay? So it's bad enough, right, that these things will gouge you up front and charge you this 5% sales charge, okay? But on top of that, they have expense ratios. That is an annual charge. Now, even index funds, even these good Vanguard funds that I talk about so positively, they're going to have an expense ratio. It's much lower. It's 0.25%. I think that's fine, personally. Okay? I think that's fine. But a managed fund, again, statistically, the fund that has underperformed these index funds, a fund that has no guarantees like a fixed index annuity, no bonuses, nothing like that, a managed fund, the average is about 1.5% a year. So hold the phone here. I'm going to give you $100,000 to invest. I'm going to get no guarantees. You're going to charge me $5,250 up front, and then you're going to gouge me another $1,500 every year? So, for example, the expense ratio for that OIEIX on the A share is 1.04%. And on the C share, if I wanted that lower deferred sales charge, well, you want the lower deferred sales charge, the C share? We're going to hike up the expense ratio. Now you're paying 1.57%. Okay. How do you see this stuff? Well, that's what we're going to get to in just a second. That's the exciting thing. Now, a couple things that I want to show you, and this will be recorded. Email annuity at Family First Life. That's annuity at Family First Life if you want a copy of this presentation. Okay. But as you increase your knowledge, I encourage you to know a couple of terms. Real technical sounding terms that make you seem smart. And I'll tell you what, terms that would give your clients a lot of confidence when you start to decode these things for them. When you're looking at a statement right now, if you knew nothing, you're a new agent or an agent that doesn't sell annuities very much or doesn't understand these statements, and you take a client's statement, you look at it, and it has OIEIX, it has this alphabet soup of ticker symbols, you have no idea what it means. I'm telling you what it means. It means that's the ticker symbol for the mutual fund. Okay, got it. And then you're going to see a little A or B or C next to it. Okay, I remember that. Now that means what kind of share it is, right? Does it have a load fee? What's the expense ratio is? And now you can see it's actually giving you the keys to the castle. It's telling you, look me up. I'll tell you exactly how much I cost and exactly how much I've returned. Right? And that's when you can apply a couple terms. I'm going to go through two of them real quick. Now, are these necessary to go out and sell annuities? No. But if you should pride yourself on understanding this stuff, not necessarily just as an annuity sales expert or retirement income expert, but as a citizen, as an individual. This is public information. This information was created by the Securities and Exchange Commission to protect you, yet most people don't know it. So let's learn it. What is an R squared number? You want to know what it is? Type in R space squared into Google and the ticker symbol. R squared for OIEIX. R squared for this ticker, that ticker. You can look up the R squared number for any mutual fund. What is an R squared number? What does it mean? It's a number between 0 and 100 that tracks how closely the fund coincides with the benchmark index. Now, if that sounded confusing, it shouldn't. It's usually the S&P 500. So the S&P 500 is an index. It doesn't have any judgment. It doesn't have people telling it what to do. It goes up when stocks are being bought, and it goes down when stocks are being sold. And it's weighted based on the top 500 companies and how large they are in the United States. So the S&P 500, Standard & Poor's 500 index, goes up and down agnostically. It's the market, okay? So an R-squared number tells you how a mutual fund tracked the S&P 500. So, for example, the J.P. Morgan Equity Income Fund I had mentioned, the OIEIX ticker, it has an R-squared number of 93. Well, the highest number you can have is 100, meaning that it tracks the S&P 500 to 100% accuracy. But I'll tell you what, 93, that's really close. That means that this mutual fund tracks the S&P. It mimics it with 93% accuracy. Well, why is that important? I'll tell you why that's important. You're going to charge me 5%, 5.25% up front. You're going to charge me another 1+% every year. And we haven't even mentioned additional fees. You're going to charge me all of this, and you're going to mimic the S&P 500 with 93% accuracy? Do you know why an R-squared number was invented for public use? Because too many companies were creating mutual funds that mimicked the S&P 500. In fact, if you start getting an R-squared that gets up to 97, 98, 99%, and you're charging a load fee or a management fee, you're going to get shut down by the Securities and Exchange Commission. It won't fly. Well, this is getting pretty close. 93% accuracy, huh? The other term I want to talk to you about is alpha. Okay? Alpha is simply a percentage that indicates if the fund has outperformed or underperformed the S&P 500. See, we track how closely it represents it, but we don't know to which side that fell, positive or negative. The alpha is what was its performance in comparison to. So you hear Matt talk about this all the time. Hey, if you just put your money into the S&P 500, right, bought something called like a SPDR, an SPX ETF, right? If you just purchased it through Vanguard, kept the fees really, really down, you would have done this. You would have followed the S&P 500. You could actually buy mutual fund, or you can buy ETFs that are pieces of the S&P 500. That would be kind of your baseline. Or you could spend 5.25% and 1% a year on this mutual fund that's managed. The alpha tells you if you were wrong or right. The alpha tells you if it overperformed or underperformed. So get this, that same J.P. Morgan equity fund, and I'm not picking on it, it's just I picked it out. I could have picked a lot worse ones. But OIEIX had an alpha of negative 1.52% over the last 3 years. Negative 1.52%. I'll say it again. Hold the phone. I'm going to give you $100,000. You're going to charge me 5.25% up front. You're keeping $5+ grand out of my money, hard-earned money. You're going to charge me another 1.04% every year, and we haven't even talked about additional fees that apply. And then you're going to underperform the market by 1.5%. Why in the heck would I do that? See, those are the things that we have to be able to find out, and they're all right there. They're all in the statement. See, think back to what I just said. All you need to do is be able to look up a 5, well, sometimes it's 5, sometimes it's 4, it could be down to 2 or 1, but look up those 5 letters. Look up the ticker symbol. I've just told you, grab a client statement, look at it. If you have your own retirement in some sort of mutual funds, take a look at it. If you want to Google mutual fund ticker symbols, take a look at them. Janus funds, right? Fidelity funds. The list goes on and on. Get an idea, practice it. But here's the tool. It's a tool that when we taught this in Los Angeles, Andrew went out the next day and wrote a $280,000 annuity based on this tool. You go to marketwatch.com, tools, mutual funds compare, right? Or just Google MarketWatch mutual fund comparison tool. It'll pop right up. I'll also send you a copy of this if you want. Just email annuity@Family First Life. And you can type in up to 5 ticker symbols. Mutual fund comparison tool. So what I show you here is if you were looking at someone's statement, See, look at my screen here. See the second one down, the third one down, the fourth one down, the fifth one? SHAPX. Hold on, my screen just stopped being shared. Good timing, right? Okay, should be back up. There's a ticker, SHAPX, and it's CB appreciation semicolon A, and the A is capitalized and scrunched up against it. What in the heck is that, right? If you had never heard this or you didn't know this and you looked at that on someone's statement, you have no idea what that is. Now you do. Now you can look at it and you say, oh, SHAPX, that's a mutual fund. It's a mutual fund. I can tell because it has that ticker symbol. And CB appreciation, well, that's just what they named it. But that A, oh, that A is telling me it's an A share. It has a load fee. It has a sales charge. So you go to this mutual fund comparison tool at MarketWatch. Again, go to Google, type in MarketWatch mutual fund comparison tool, or copy and paste this URL that I'll give you. And look at this. When Andrew showed this to his client on his mobile phone, and he pulled these off of the client's statement, these came from that client's statement, their jaw dropped. Andrew was able to point it to him. So this one, did you know they charge you 5.75% up front? And this one, they charge you 5.75% up front. And this one, they charge you, and he went through it. It gets worse. So I'm glad you're sitting down. Because now they're charging you additional 1% every year, and 1.29% on this one, and 1.15% on this one. Remember I said there's even additional fees? See this 12B-1? That's a fee. Oh, I didn't mention that. There's another 0.25%, because they need to pay people and keep the lights on and pay for reports and faxes. We're looking in the first year, first fast forward, put money in, put $100,000 in with no guarantees. In fact, the track record in many of these shows that they've underperformed the markets, and they're going to take out $5,750, followed by another 1% plus another 0.25%, and they're going to keep charging that 1 and that 1.25% every year, regardless of how it performs. That's the tool that we need to be able to show our clients. Okay, so we just talked about mutual funds because they dominate the landscape of our current clients' retirements. You have to be able to pick up a statement, look at it, try to identify some ticker symbols, try to look for those A's, meaning A share, B share, C share, and pump them into the mutual fund comparison tool at MarketWatch. That's not hard to do. You start doing that, you're going to turn a lot of heads. Why? Because who here in retirement can go ahead and handle a 5% loss year to year? Who here can have a consistent 1.5%, even 2% loss every year with no guarantees of upside? Something I like to verbally express to people, or it's even better if you write it out, is I'll take their retirement amount. This is a sales tip for you. Once you start understanding this, this is a great sales tip. Let's say the client has $350,000. And they got Social Security. They're feeling pretty good. And you estimate that they have to take out $20,000 a year or $15,000 a year. Okay? So they have this, let's say, $315,000. And as long as the market goes up, they'll feel great. But the problem is they're looking at these average returns as if the market returns linear. Well, the market on average will give you 7%, 7%. So they have like this vision of a line just consistently going up and to the right. That's not how the market works. The market goes up and then down and then up and then down. Do you remember 2008? Do you remember 2001? For our clients, some of them, do you remember 1975? Do you remember the Great Depression? Okay, hopefully not too many people are that old. But my point is this. If you have $315,000, the market's going to do one of two things. It's going to go up or it goes down. Now, if it goes up, you're probably good for another year. But we've just determined that you have to take out $15,000 a year. So let's say the market goes down 10%. Before you even draw down your money, you've lost $31,000. So let's just round that down to $280,000. Now you're going to take out now you're going to take out that $15,000. So now you're at $265,000. And then see these fees, right? 1%, 2%. So now you're down to $260,000. In 1 year, Mr. Smith, Mrs. Jones, in 1 year, your retirement just went from $315,000 to 260. Do you think you can sustain that? How's age 67 going to look? 68, 69. See, that's the thing you have to do. This is sales, and this is real. They don't know what the market's going to do, nor do you, nor does the market, nor does the president, nor does the financial advisor that they work with. And by work with, I say that almost tongue-in-cheek, because most of the clients we run into have less than $500,000, have less than $300,000. Do you think really that their RIA, their financial advisor, and again, I'm saying that almost sarcastically, even knows they exist? The answer is no. Now, quickly, I want to cover off bonds, okay? Bonds are regulated by the Securities and Exchange Commission also. Bonds come in a couple different forms. And bonds, because they have more secure returns, are used heavily by financial advisors. It's smart, right? They understand it. They're not stupid. They understand that the market could do this. They understand that their client could go from 315 down to 216 a year. That's why they try to eliminate that volatility. How do you do that? Well, you start to saturate your retirement portfolio with a lot of bonds. Bonds are more secure. Bonds are even, in some cases, guaranteed. But bonds are going to give much smaller returns or have much smaller return potential than fixed index annuities. Let's take a look. Municipal bonds, okay? So municipal bonds are tax-free. That's the cool thing about them. If I get a yield, if I get 2% off a municipal bond, that 2% I get, I don't pay tax on. Heck yeah, high five, right? Okay, it's 2%. I'm showing you a AAA rated, right, because you want something that's very secure in retirement, 10-year bond. The coupon rate is 1.83. So you won't pay taxes. It's AAA rated. It's not going to default. It's as good as guaranteed. That's the way I look at it. And you're going to get 1.83% for a 10-year. I know of an Athene annuity that gives you a 9% bonus on a 10-year product. I know an excellent AIG annuity that gives you a 3% cash bonus on a 10-year product. How many years would I have to go at 1.83% to get to a 9% bonus? Right? What's better, a bond or a fixed index annuity? I can make a strong argument that the bond is. You know, and it's not just me. Look up Professor Wade Pfau, right? These are people that are much smarter than me. These are people that have a true education, mathematics education, a background, and they're saying bonds are inferior to annuities. Let's look at the guaranteed bond, a U.S. Treasury bond. It's guaranteed by the full faith of the federal government, okay? Now, you pay tax on it, right? But a 10-year bond is still 1.91%. Do you think you could live off of making 1.91%? Yet the idea of taking bonds for income, laddering bonds, cashing in bonds, is common practice for financial advisors. Now, you can get a little higher return if you take non-guaranteed bonds, corporate bonds, okay? But even if you keep that investment grade, look at the returns. 2.77%. See, most financial advisors place these baby boomers into bond-heavy mutual funds. So they're getting security. I don't contest that. You notice I'm not talking about default rates or what if the government goes bankrupt or all that silly stuff. I'm simply pointing out that you're going to get security, but the returns are going to be puny, and they're still charging you fees. So why? Why would you choose bonds? And that's an easy target because we can point to mutual funds, we can point to bonds. That's what you're going to find in your retirement statements, and that's what you can now decode and look at. Okay. I call this the indexing revolution. See, the idea of mutual funds that are managed is going to go away. I believe so. One, I think it should go away. Two, I believe it will go away eventually in one form or another. The idea of charging people these tricky fees, do you think your clients know how to look up a ticker symbol and do the market watch comparison tool? Do you think they even know if you said 12B-1? They would know what you're talking about. 12B-1? I don't know what that is. If you said, what's the difference between A share, B share, and C share, do you think your client would know? The answer is heck no, they wouldn't. Yet they exist. Yet clients are being charged all this money. So for a human being to make a decision, humans are very flawed. I think I lead the pack in that, right? That's why I'm not choosing stocks for people. So the indexing revolution changes things. This is the day and age of our cars driving by themselves, of our smartphones doing everything. This is the day and age of iPads and galaxies and everything is technology driven. So why are we using archaic practices? They don't have to. See, consider yourself as someone who represents Athene, AIG, these index strategies. Consider yourself someone who is cutting edge. We sometimes feel inferior. You're only inferior if you're trying to make stock suggestions because you don't have the license for that. You're only inferior if you're trying to argue that putting your money into an annuity every month is better than putting your money into the market. It's not. Accumulation is better done in the market. I expressed that earlier. I explained that earlier. But when it comes to decumulation, when it comes to retirement income planning, you've got these financial advisors charging fees every year trying to figure out a way to not screw it up. And they're offering no guarantees and they're offering expensive investments. Why? See, with indexing, with technology, we can do 100% rules-based designs. So there's no dependence on human investment and no depend on human judgment on what a human's investment is going to be, what they think the return is going to be. It's all simply computer driven, which makes it cheaper, and which takes that risk out of it. It's a way to control that volatility, and that's what Athene uses. Okay, Athene has an uncapped strategy that is one of the most respected and highest accumulating out there. In your reports, in your illustrations, I want to show you something that a lot of people don't know exists. In fact, I was pointing this out to Mark the other day. He said, "This is perfect. This is what I need to sell this annuity." So we don't go out there and say, "Hey, I'm going to give you something that's better than the market. I'm going to show you a way to outperform the market." We go out there and we say there are 3 things you can do with your money in retirement, Mrs. Smith. You can leave it into the stock markets. And the stock markets, they have the highest gain potential, but they also have the highest risk. And oh, by the way, let me look at your statement. There might be some fees you're not aware of. How would you like your retirement to go from $315 down to $260 in 1 year? And you only took out $15K. The rest was from fees and market volatility, right? You see how we start to piece this together? But it's an option. It is an option to leave that money in the market. The other option is the banks. You're going to get all sorts of security, but you better be happy getting 1%. Or 0.75% in a CD. And then the third option is annuities. Annuities have progressed so much. Annuities don't rely on some person, some high-paid, white-collared person there in Manhattan to make decisions on what stocks to buy and not buy when there's no guarantees, bunch of fees, and in fact, I can show you that it's underperformed the market. Annuities use rules-based decisions. Let me show you something here. This Athene Performance Elite uses a rules-based algorithm, a volatility-controlled decision-making engine, if you will, that will never lose money. See, that's the thing about a fixed index annuity. That's where we use the trifold. We say, see how the market goes up, your annuity can go up, but when the market goes down, you'll never lose value. You lock it in. You're consistently buying low, selling high. You've eliminated fear of loss. You've eliminated sequence of returns risk. And oh, by the way, the returns might be more competitive than you think. Let me show you this. And I'm going to show them this portion of the illustration. I'm going to show them 3 things. Using this index that I'm going to have you purchase, I'm going to show you three different scenarios that are based on real data over the last 20 years. The first one I'm going to show you is the most recent decade. If you had your money in this product over the last decade, year 1, because this is a 2-year crediting, year 1, it's not applicable. You wouldn't have received anything. Year 2, you would have gotten almost 16%. Year 4, nothing. Year 6, you would have received 26%. Year 8, 11%. Year 10, 26% again. You would have averaged year to year, even though this thing only credits every other year, that just happens to be the indexing strategy we chose, you're going to get 7.48% without any fear of loss, without any load fees. In fact, you get a bonus to start out with. And that's not even the highest scenario. If all the things aligned correctly and we got to pick the highest 10-year period out of the last 2 decades, you would have received 7.99%. And I know what you're thinking, Mrs. Smith. These are all rosy pictures. What about a bad scenario? Well, because you get a bonus, because you never lose money in a fixed index annuity, the lowest scenario you could have had over the last 2 decades, you would have made 5.86% compounding interest. 5.86, worst case. Do you think there's any retirees back in 2001, back in 2008 that would have been happy to have their worst case scenario be 5.86% without losing money? And that's obviously a rhetorical question. It starts with this. You need to be doing a proper financial inventory. Every client, every time. Start to gain confidence in this. Start to ask your warm market. Put retirement specialist, retirement income specialist. I'm not saying put a designation you don't have. Don't put CFP or RICP or anything like that. But say, I specialize in annuities. I specialize in retirement income planning. Put it on your business card. Engage your warm market. Be bold. Be proud of what you do. Because all you have to do is get a client who understands that there's 3 things they can do with their retirement. They can put it in the markets, they can put it with the banks, or they can choose annuities. And understand that they've never really been shown annuities. If they understand annuities at all, it's usually an antiquated understanding of it. Or it's an understanding that came from their brother, the plumber, who heard it once on, Paul Harvey. I'm saying it's just crazy what people's interpretation is. Yet we sit there kind of scared to help them. Don't be scared. I'm telling you, have confidence in it. Explain to them, show them, take their statement out and say, see, we can look up this ticker symbol. This is what it did. This is what it performed. This is what they charged you. See that little A? You start showing them how to decode that, they're going to gain a quick sense of loyalty to you because you're showing them how much they're losing. You're showing them how much they're paying for no guarantee. And then the alternative is a fixed index annuity. So go in, log into your Family First Life account, click on the CRM. Just choose the Ask a Specialist, and on the Ask a Specialist, it gives you the guide rails. You can't. It's like an e-app. You can't continue unless you do it correctly, and that makes sure that everything back to the annuity department gets sent there. You'll get returned with you a set of illustrations, options, a narrative, and even a time that if you want to speak to one of the experts to explain it, you can, and in an application. It's the reason we broke all our records last year and did over $35 million in annuity production. It's the reason we're going to do over $50 million in annuity production, because here's the key thing. Here's the thing that everybody should be excited about, and I'll end the call with. We sold a record amount of annuities. The industry sold a record amount of annuities, fixed index annuities, at a time when the market was at an all-time high. Does anyone have a client, a friend, a spouse, a relative who said, my goodness, the market just dropped? For first week of the year when the market tanked by 400 points and their retirement accounts went down? I'm telling you, again, this is my opinion, but a lot of experts would agree, the market is going to correct itself. This is going to be the year, brace up, that the market starts sliding. We're going to make hay. How many annuities are you going to sell when you say, I understand you just lost $42,000? Good news is I have a product that's going to give you a bonus, make some of that up. It's going to eliminate that expense ratio, that fee you're paying, and it's going to guarantee you never lose money. You can only go up. And by the way, here's what it did over the last 10 years. Here's what it did best case over the last 20 years, and here's what it did worst case. How do those numbers look to you? Sign me up. We're going to break $50 million this year. If you have any questions, email annuity@Family First Life. This is recorded. It'll be sent out to everyone. I can also send a copy to anyone that emails us at annuity@Family First Life. I ran a little late. Hope that's okay. I appreciate everybody being on. We had a good audience, good views. Thank you so much. Make it a great week. Bye.